Space is vast, mysterious, and governed by unseen forces. The stars, planets, and galaxies all move in a delicate dance, influenced by gravity and other cosmic forces. But guess what? So is our economy. It's a complex system, bustling with activity, and driven by forces that are often invisible to the naked eye. Just like gravity shapes galaxies, monetary policy shapes our financial universe. It determines the flow of money, the rise and fall of markets, and the overall health of our economic system. It's the invisible hand guiding interest rates, money supply, and ultimately how much we pay for that morning coffee. Every transaction, from buying a cup of coffee to purchasing a home, is influenced by these unseen forces. Ever heard of inflation? It's like the expanding universe, but instead of galaxies drifting apart, it's your dollar losing its purchasing power. Prices rise, and the value of money decreases, making everything more expensive. In fact, in 2023, the US saw its highest inflation in 40 years. This surge in prices affected everything from groceries to gas, making it harder for people to make ends meet. That's a lot of cosmic chaos for your wallet to handle. The rising costs can create stress and uncertainty, impacting everyday life and financial stability. This is where monetary policy comes in. Economists and policymakers work tirelessly to manage these forces, aiming to keep the economy balanced and healthy. It's the control panel economists use to tweak and adjust our financial system, trying to keep things stable amidst the economic cosmos. By adjusting interest rates and regulating the money supply, they strive to maintain economic stability and growth. Imagine the economy as a massive spaceship hurtling through the cosmos. Active monetary policy is like having a skilled pilot at the helm, constantly adjusting thrusters and navigation to avoid asteroids and black holes like recessions. Passive policy, on the other hand, is more like setting the ship on autopilot. It relies on pre-programmed rules and the belief that the economy, like a well-built spacecraft, can mostly self-correct. Both approaches have their merits, just like choosing between a daring pilot or a reliable autopilot. Active policy offers flexibility and quick reactions, while passive policy promotes stability and predictability. Today, our economic spaceship is navigating a particularly treacherous asteroid field. We're grappling with the aftermath of a global pandemic, supply chain disruptions, and geopolitical turmoil. Inflation is still a lurking threat, while the specter of recession looms large. This is where the choice between active and passive monetary policy becomes critically important. The wrong decision could send us spiraling off course, while the right one could steer us towards a brighter economic future. Active monetary policy is a powerful tool that central banks wield with great responsibility. It allows central banks to respond swiftly to economic shocks, like a sudden spike in inflation or a stock market crash, ensuring stability in turbulent times. By adjusting interest rates and money supply, they can stimulate growth or curb inflation as needed, acting as the economy's first line of defense. Think of it like adjusting the thermostat in your house, where precision is key to maintaining comfort. If it gets too hot, you turn down the heat to cool things off. Too cold? You crank it up to warm the environment. Active policy aims to maintain a comfortable economic temperature, balancing growth and stability. However, like any powerful tool, it has its risks and potential downsides. Too much tinkering can create uncertainty and volatility, making businesses and investors nervous, leading to a lack of confidence in the market. There's also the danger of human error. Even the best economists can misjudge the economy, leading to unintended consequences that can ripple through the financial system. Thus, while active monetary policy is essential, it requires careful calibration and constant vigilance to avoid pitfalls and ensure economic health. Section 5. Passive policy, steady as she goes, but can it weather the storm? Passive monetary policy, in contrast, is all about predictability and long-term stability. It aims to create a stable economic environment where businesses and consumers can make long-term plans without worrying about sudden changes in policy. It operates on preset rules, like a cosmic clock, and avoids sudden policy shifts that could disrupt the economic flow. This methodical approach ensures that the economy runs smoothly, much like the precise movements of clock gears working in perfect harmony. This approach has its advantages. By sticking to a predictable path, it fosters a sense of security and trust among investors and businesses. It promotes transparency and reduces uncertainty, allowing businesses to plan for the future with more confidence. When companies know what to expect, they can make better decisions regarding investments, hiring, and expansion. It also minimizes the risk of human error by relying on predetermined guidelines. Automated systems and clear policies reduce the chances of mistakes that could arise from human judgment or bias. However, its strength can also be its weakness. The rigidity of passive policy means it may not be flexible enough to respond to sudden economic shocks or crises. In times of unexpected turbulence, like the economic storms we face today, a rigid, rule-based approach may not be enough. The inability to adapt quickly to changing circumstances can leave the economy vulnerable. It's like trying to navigate a raging hurricane with a pre-programmed flight path. You might need a more adaptable strategy to survive. Flexibility and the ability to make real-time decisions are crucial when facing unpredictable challenges. Section 6, the 2024 dilemma, to act or not to act. So, as we hurtle towards 2024, the question remains, active or passive? Should we trust in the steady hand of preset rules or embrace the flexibility of active intervention? There's no easy answer. It's like choosing between the calculated precision of a robot and the intuition of a seasoned explorer. Both approaches have their strengths and weaknesses, and the best path forward depends on the specific challenges we face. One thing's for sure, the stakes are high. The decisions made in the coming year will have a profound impact on our economic trajectory, shaping the financial landscape for years to come. Section 7. The future of our financial universe. Just like the universe itself, the future of our economy is full of unknowns. Will inflation cool down? Will we avoid a recession? These are questions that even the brightest economic minds can't answer with certainty. But one thing is certain, the choices we make today will determine the course of our economic journey. Whether we choose the dynamic path of active policy or the steady course of passive measures, we must proceed with caution, foresight, and a deep understanding of the forces at play. Section 8. Join the cosmic conversation. So what do you think? Should we embrace the dynamism of active monetary policy or seek solace in the stability of passive measures? The cosmos of economics is vast and ever-changing, and your voice is part of the equation. Share your thoughts, engage in the debate, and together, let's explore the frontiers of our financial universe.